Hi, welcome back to our Investor Facts series, video 8. And this is going to be the final video here, going through all three investor sheets to be able to analyze an investment and find out if that investment is right for you. Getting back to where we left off, so now we're at the debt service. So this goes through and shows you exactly what your mortgage payments are for that property. And then you have your debt service cover ratio. Like I had said this in a couple of the past videos, the bare minimal amount is a 1.2. And as you can see with this property, we're at a 1.8, ending in a 2.2. So what that means, just once again real quick in case you didn't see one of the other past videos, let's just say, use simple numbers, if your mortgage is $1,000 a month, the bare minimal rental income that you could collect would be $1,200 a month, and that is a 1.2. So in this scenario, if our mortgage is $1,000 a month, we're actually collecting $1,856 a month in rents. And by year 5, we're collecting $2,242 a month in rents to pay a $1,000 a month mortgage. So you can see why I'm so excited about this project. Now, right here, what we're going to discuss is the maximum loan analysis. So what you always want to do is you want to be able to take a look and find out what is the maximum loan that you can get at a 1.25 debt service cover ratio. Remember, the bare minimum is a 1.2, but I like to be conservative and go to a 1.25. So basically what we have, and this is assuming a 7% 25-year term. I'm using a little bit higher of an interest rate as well, because I don't want to have this all, where you always want to be able to show, promise and and be able to exceed all of your promises and expectations to your investors, and that's what I'm trying to do. So what we have is year 1. Available for debt service is $1.4 million. Maximum loan 16.7. The value using an 8.5 cap ratio, which is a good average. 7.5 would actually bring the value even a little bit higher, but I like to use the 8.5. So that gives us a value of 21. Using a 75% LTV, and that's your loan to value ratio, we would be at 15.8. And all the way in year 5, you have the value at $25.4 million, being able to have a maximum loan of 20.1, and using your 75% LTV of $19.1 million. So what you always want to do is you're going to look at this, and you're either going to use the max loan at the 1.25 debt service cover ratio, or you're going to use the 75 LTV, because most lenders will not go above 75 LTV. So what this is saying is, in this scenario, we would always just refinance it right at the 75 LTV, giving us much room where we actually could get a bigger loan, but we just wouldn't take out any extra money on that. Now what we're doing is you're going to look at your cash flow. So the initial year 0, you put up $2.5 million, for the down payment, and then this is giving you your cash flow per year on this project. So at the very end, we're at 5.6. Being able, this is the profit that you're getting by selling the property. So here's your totals right here. So for year 0, you're negative 2.5 million, and then here is your cash flow per year. And then upon sale, you're getting the profit that you made upon sale of the 5.6 million, plus the regular cash flow of 1.2 million to equal $6.8 million. Now your present value, what this is they're calculating it based on a 10% investor return from your current investments. So anytime that this number is a positive number, you know that this was a great investment, and this will do a lot more than your 10%. So what this is calculating is, if you did not invest in this and you had $2.5 million, would you be better off with the $2.5 million and continue doing your own investments? or get involved in this investment. And in this scenario, this would be $4.7 million better than your 10%. And then you want to look at your internal rate of return, the IRR, 47.7, that's really good. And then your cash on cash return, this is before taxes, of 33 all the way to 44, and then upon sale 275%. And then we're going to look at our annualized cash on cash return, which is 85.9% returns, which is just outrageous. Now what you want to also look at is your gross income monthly per unit, and you'll see how slowly it goes up. But we're not looking, we're not saying that we're charging $1,000 a month for each unit. We're at $796. Expenses per unit, $310. Your net income per unit is $208, and your net income multiplier, the NIM ratio, is a 10.2, which is very good also. So I will go into more detail on each ratio in its own separate video, but this gives you a very good idea, and we definitely would love to see you get involved, and email us for more information, and we definitely would like to see you sign a letter of intent and get started, and let's all make some money. I hope that you are learning a lot from these videos, and remember, follow us on all our social media, and join our email list, and let's make money. Hopefully we will partner in the future and we can make money together. All right, have a great day. I'll talk to you later.